Welcome to another edition of the Mistake-Free Real Estate Podcast. I am your host, Marck, and today joined by a mortgage nerd. I absolutely love Aaron. He's a good friend of mine, and I use that term very endearingly because I love to go deep on mortgages and interest rates and inflation. And today, guys, we have someone who knows all about it. So for those that are nervous about what's happening in the marketplace or interest rates going up, inflation out of control, today we're going to dive deep with someone who knows all about it. So my good buddy, Aaron Chapman, welcome to the show.
So, Mark, thanks for the invite, brother.
Always, man. Thank you for taking some time. So let's dive right in. Interest rates are going up. What is your take on how that is impacting the economy, and what are you seeing on the streets?
The most impact that I have witnessed is it's really making people take a bigger pause than they normally would looking at a transaction, but it's also making people get really, really real about where the value of real estate is. So, in my opinion, it's a good thing. Because it was easy for a person to go just charging into a deal and make it pencil when your interest rate's 3.5%. That's not hard. You've got a lot of people that now get to become investors, but they're not really investors. They're just opportunivores. If you've got an actual investor, they're going to look at things a little bit deeper. So it gives me the opportunity to sit with these folks and talk to them about where the real value is in leverage real estate and what really generates wealth. It's not your interest rate. And so it gets out those who are really just trying to get in there and get that great cash on cash return, which there's nothing wrong with that. It was a great time to get in there. Why not get involved? But it really, it has slowed down the market. It's slowed down for a lot of folks. But I think they're starting to wrap their head around it. They're coming back in it, and it's going to change the dynamic of their business and going to make them better business people.
You know, we always talk about the four pillars of real estate and why we invest. Obviously, only one of them is cash flow or cash on cash return. But your other ones are appreciation, the tax benefits or depreciation, as well as the ability to leverage, right? I mean, that's one of the greatest things out there. Are the banks still lending at 80% LTV?
All day long.
Yeah.
But at least we are. I know that it's funny. I talk to a lot of investors, call me up, say, is it possible to get an 80% with you guys? Everybody else is telling me they're required to do 75. I'm like, they're not required to do 75. It's because those some bitches can't sell an interest rate at 80. So it's easy to be able to sell you a 75 rate because it rolls off the tongue better.
Yeah.
So let's talk about the importance of this. And that's where I get into the depth of, especially of the leverage piece and how, in my opinion, and not even my opinion, on the numbers, it's the most valuable part of the whole transaction, and everything else is ancillary. Once they wrap their head around that, it's amazing how confident they become to walk into a deal and say, cool, I'll put 20% down. I'll take that higher rate and I'll pay those points because they know what the score is.
So now we're, what are we? Just end of August 2022 to kind of mark the date and time, because we are talking specifics. Rates are somewhere in the, 6% range?
Yeah, just a little over 6%, and a person's going to end up shelling out a point, maybe a point and a half, sometimes a little bit less than that to get it. And it's just the way things are working for the real estate investor these days.
So next 6 months, where do you see rates? Will rates continue to tick up a little bit? We got one more interest rate increase or no?
Well, we definitely could have another. Well, I don't doubt we're going to have another interest rate increase. We just had another conversation from the Fed. They're not planning on slowing that down. And a lot of people are freaking out because they did 0.75% jumps rather than the quarters that they were doing in the past. But if you go all the way back to the last time we experienced inflation of this level, Paul Volcker was the chairman of the Fed, and he was doing like 4% and 5% raises overnight. And they were in the 20s, at a 20% federal fund rate versus a 2.5 right now. What's also interesting, even though the Fed raises the rate, they did that last time at that 3/4, it brought our interest rates down. Why did it do that? Because it's combating inflation. And what's happening with inflation, the higher it goes, we have to raise rates, because when a person's putting their money up and giving it to you, say you, Mark, for 30 years, and their burn rate on the value of that money is at today's inflation rate, if you're just going off the CPI, is 8.5%.
Yeah.
It's cost them 8.5% to have their money on deploy, and they're not using it somewhere else, but yet they're only getting, say, 6.125% from you. That doesn't pencil to be a valuable investment for them. So in these cases where you've got points coming up front and there's some money going back to the market that way, I'm guessing they're making sense of it. But me personally, I wouldn't lend that money to you at all at that point. If I'm not getting 12, it's not leaving my pocket.
Yeah. So talk to me about mortgages and like kind of I know you're a history buff and you know mortgages in detail. Talk to me about where we stand in relation to I feel like most of our audience has been spoiled, as I have, obviously, as we all have, by the last 10 years of extremely low interest rates. But when I first started investing, I was super stoked to get a 5.75 rate, from a local bank. And then they've just come consistently down and down and down. So refis. Now we're going to go through this other period. But talk to me about where we stand in terms of historically, where do we sit with the 6.25 rate right now?
Well, I find one interesting that you bring up your first one, you get a 5.75 and it's just gone down. So there's a lot of people in that same scenario. So they're just of the belief it's just going to go down, right? Or stay low to that effect. Well, if you go all the way back, we're going to go back to 1971. You start kind of seeing how the 30-year fixed has evolved, or at least priced out for that period of time. Mm-hmm. If you go from 1971 to 2009, that was literally a real market playing at that time when it comes to the mortgage-backed securities. And the mortgage-backed securities is where all the money comes from to lend out. Have you seen The Big Short?
Yeah.
So at the beginning of that, it talks about the guy, Lou Ranieri. He worked for Salomon Brothers, and he saw how local banks would take depositors' money, they'd put it in their accounts, and they'd lend it out to the local area for their houses, their farms, or wherever else. They'd pay the account holder maybe 3, 4, 5, 8% if it's a CD, but they would charge 18 to 20%, and they get this big ass spread, right? And there's other things they had to pay out, but they still had a massive spread. So like, why don't we do this on a grand scale? So they did. And that's where we got the mortgage-backed security, and that's where we got our 30-year fix created and all these things. Well, if you look at the average from the time that was all starting till 2009, before the Fed got involved and started using quantitative easing to mess with things after the crash, the average interest rate for your homeowner, person buying it to live in, was 9.11%. That was for people buying a house to live in. Now, you go and fast forward, you take all the stuff they did during the pandemic and they did during quantitative easing after the crash. The average from 1971 to 2022 is 7.769. So almost 0.78%, just a hair under 8% is the average for people living in the house. So what's interesting, you throw in 2009, we have the crash. Quantitative easing starts from January 1st, 2009 to the end of March 2010. Mm-hmm. They dumped in $1.25 trillion into the mortgage-backed securities pools at that point to bring down rates where they were. And I remember when that started happening in 2009, 2010 is the first time I saw an interest rate for an investor, because I've been working with investors since 2003, go below 7%. Because before that, in the sevens was a great rate. We're seeing 8s and 9s all the time. We got in the sevens. It was like it was amazing how much business came in. Then we broke 6.875 in like 2010. I couldn't believe this, and they kept feeding that monkey by $40+ billion a month. And then they tried to taper off in 2018, and it had a negative reaction in the market. It's like, well, maybe we should get back into this. And then the pandemic happens. And then you had that massive margin call in the stock market and all these different things that occurred that created a massive drop in the mortgage-backed securities to push the interest rates up 2% overnight. And we couldn't lock anything. It was crazy during March of 2020.
I can't imagine.
They dumped in $1 trillion from March 20th to March 30th, 10 days. They dumped $1 trillion in the mortgage-backed securities pools, and they kept it just pinwheeling. And by doing that, that's how we got the average interest rate from March 20th till now is 3.3%. And that's for homeowners. The average interest rate since 2009 is 4.02. So if you take those two things out, we should be double-digit interest rates for real estate investors, but we're not. So that's what I tell everybody, guys, looking at the history of it, we are in an amazing position. You should take advantage of it, because I have no idea how long it's going to last.
Where do you see rates in the long term? Do you think we'll get back to double-digit returns? Double-digit interest rates?
We better be at double-digit returns. I honestly don't believe we'll hit there, because if we were going to, they would have already been really, really pounding the raises at this point, because of where it is. And we're starting to see inflation start to ease back a little bit because of supply chain issues, and because of other costs and fuel costs and all these energy expenses. People are tapering back on their spending. The only reason inflation goes up is because there's too many dollars chasing too few items. Well, now people are like, I need to hang on to my dollars, and I'm not going to chase all these items. People aren't clicking as much on Amazon to buy the crap they really don't need, but they just bought it because they had the excess capital to use it. So because of a little bit more discerning with their funds, I think that's going to help us, and maybe they don't have to get as aggressive with the interest rates.
I know there hasn't been any knee-jerk reactions from the mortgage industry, but clearly you guys kind of had an atom bomb dropped on you with rates, increasing by 3 or 4% just in a calendar year. Has there been any talk of a 40-year fixed?
People talk about it, but to actually put it into a practical usage, it's not just a matter of talking about it, it's finding a market that will literally buy it. Right? So when you think about it, it's not the bank's money, right? It's not Fannie Mae's money. It's not Freddie Mac's money. It's not, it kind of was government. Well, it was taxpayer money the government was feeding through into that, but it's really investment capital on Wall Street. And people want to be able to say, I'm going to park my money in this particular bond and I'm going to wait 40 years to get paid back. And I'm going to wait 40 years to get paid back. It's going to be in a high inflation environment where they're paying me back with a declining instrument like the US dollar. And when you run that math, it doesn't pencil.
Yeah.
That person's losing money on you. Actually, you may pay more than double in actual dollars than what you borrowed. But when you recalculate the value of those dollars over a 30-year period, you're paying them back probably on an $80,000 deal, $80,000 loan, you're paying them back $72,535. So they're really losing money on you, and they're doing it over a long, drawn-out period of time.
So pivoting then, a different way to look at it, I had a builder I was talking to the other day who said he was actually providing an option of buying down the rate. But I feel like it's so expensive. I looked into it. It seems so expensive to be buying down the rate currently. Do you see investors doing that or new builders that are incentivizing activity or sales by buying down the rate? And do people do that really just to protect their sales price rather than dropping price? Is that one of the, or is it a sales tactic to try and help out a homeowner long term?
I honestly believe it's a sales tactic. Because when you think about it, interest rate has been made to be such an important thing, so overly important. And let me explain why it's become such an important thing. Well, one, let me answer your question. One, it's a sales tactic.
Okay.
Because you're going to draw people and say, hey, I'm going to help you out. We're going to buy down your rate. And it's like, oh, it's going to feel better because now I'm getting this better interest rate and I have a little bit more affordability. But where are they getting that money? They're getting that money from an increased price on the house. Well, affordability is going to be getting skewed one way or the other. The only reason our prices went up the way they went is because we had this enormous affordability from lower interest rates. So that means more people can go and bid on this house. Therefore, they're pushing the price up.
Yep.
It's not pushing the value up. They're pushing the price up. By pushing the price up, you're impacting affordability again. So it's kind of a double-edged sword in this whole thing. Now we're getting to a market with normalized rates, which I still think are even very, very low. And people have to get more real about their price. And we have builders who are like, man, my cost of construction is through the freaking roof. It's more expensive to build than it is to just buy something existing. So we have this really, really interesting dynamic. And I think it's really just a sales ploy to work and tickle that I guess that itch that they have in their psyche about interest rates and how that was created. Have you ever stared at a amortization table on a 30-year fixed mortgage?
Sure.
And do you recall what the first 4 years looks like?
Like you're paying down very little principal.
Yeah, hardly any.
Hardly any. It's all interest.
So I speak publicly about all this stuff, interest rates, the economy, all these things. And one of the things I bring up, because people are talking about, it's amazing how when rates drop, how often people want to refinance to get that lower interest rate. And I can show them with your amortization table. We've got a guy here, he had I got a case that I always show where he had $120,000 balance on a new loan. 4 years later, he comes to us to refinance it because the rates went down. And I explained to him, this is not something you should be doing. If you're not pulling cash out, it doesn't make any sense. Well, we couldn't talk him out of it. Well, if you looked at his amortization table, he had paid for 48 months. He dropped that balance down by $34,524. That's how much. He had paid in payment. Sorry, $34,000.
Yeah, I was going to say that would be aggressive.
No, that would be really aggressive. No, he paid 48 months of payments, $34,524, but his principal only dropped by $6,400. So when it came time to refinance his mortgage and we got the payoff, well, the payoff was $114,000 and change. He's got closing costs for lender, title, appraisal, and then he also has the prepaid items, taxes, insurance. What do you do with those? Add them to the loan. His new balance, so he started with $120,000 48 months before. When he refinanced his house and closed on it, his new balance was $119,833.96. He'd only dropped his balance after 4 years by $119,000. and $6.96. That's it. So if you get what the banking industry, when you look at how they have structured their marketing and how they've structured their way to really attack people in the way they see their mortgage, they're going out and refinancing every 4 to 5 years. Well, the banking industry, when you see that, they're just collecting interest and interest and interest and interest. And in 20 years, this guy following that pattern would pay out over $180,000 in principal and interest. Yep. His balance would be $120,000 after 20 years.
And all the transactional fees along the way. So the transactional fees of the every time he refis.
100%. So when you look at all that, you can see why interest rates become so important to people, because it's been beat into them. That's important. It's not to benefit them, it's to benefit the banking industry. So it's the worst time in my career times. I mean, there's multiple times in my career this has happened. So when I discovered this, is getting those enormous amount of calls about refinancing for rate and trying to talk my investors out of doing it. Because it doesn't benefit, to me, it's a predatory practice in my mind. I'm not saying it is, but it's just for everybody. But for me, I'm like, if it doesn't benefit them, I'm not going to do it.
Yeah, there's a time and a place, right? I mean, clearly I've, done cash out refis and I've refied to get a better rate, because I was going to hold something long term. But you're saying just in general, it's been, hey, the rate dropped a quarter point, you better refi.
Exactly. I mean, there's serial refi people out there that think they're getting themselves in a better position. They're really not. Now, for cash out, hell yeah, if you're taking money and reinvesting it, what's funny is people are like, well, I pull the money out, then I'm reinvesting it. I'm trying to figure out my cash on cash return. I said, your cash on cash is infinite, dude, because you don't have anything in it. None of it's your money.
Ain't your money, bro.
Exactly. Belongs to somebody else. And then somebody else is paying it back. So you have nothing in the deal. You have an infinite return. You have the greatest return in existence.
So at the end of the day, what I would think I'm hearing in your the investors that are listening to this podcast would be thinking is, look, if I find there are enough qualified deals out there. If I go find a qualified deal, 6% interest rate, we can make the math pencil all day long.
Yeah, and it really what it boils down to is looking at your market. What I tell everybody, if you want to find a deal that works for you, you have two jobs. You're the CEO of your real estate investment business. You need to pick the right people to work with. They're going to basically help you run your business, and your guys' outfit is second to none in how you guys do your business. So there's no reason why they can't do very well with SBD. Then you've got, on the finance perspective, you got to get the right people to work with you, but then you have to find the right business. What I mean the right business, by the right property that you can keep reasonably rented for the entire time you own it, and you can raise rents. Mm-hmm. The benefit of inflation, we're talking about all the drawbacks, but the benefit is the rent goes up. And how often has the rent gone down in history? It
doesn't happen.
And so because of that, what you see is you get a compound growth. Let's say $100,000 purchase. I know that purchase is kind of rare these days, and you're renting it for $1,000 a month. Even if you're only making $150 a month in cash flow, which doesn't excite people, if you raise rents by 3% the next year, that's $30. Well, that $30 increased on your 150 cash flow is a 20% compound increase in your cash flow. You're literally getting double-digit increases on your cash flow, while the lender you're paying back is getting a compound decline in the instrument you're paying them back with. You get to keep the spread. So I tell folks is you need to look at not just your pro forma and your cash on cash return out of the gate. Look at years 3, 4, and 5. Patience turns anybody into a genius when you're looking at residential real estate.
100%. Dude, cannot agree with you more on that. Like I always say, I mean, don't wait to buy real estate and wait. When you talk about patience being the number one attribute of a high quality investor, I could not agree with you anymore. We actually just had a stat, Aaron, that was talked about on our morning huddle this morning. Our director of property management mentioned that she'd just been going over numbers, and in the month of July, we had increased rents 14.7% on average. That was just in the month of July on all on all of the turns that happened in the month of July, and I think there were about 30 turns with either the renewals or the turns that we made. Rents went up 14%.
That's amazing number. And if anybody who's not, if you guys need to pause there and just wrap your head around that number right there, that's massive.
It's a huge increase, and there's many reasons why. But at the end of the day, a good operator for your real estate investment is paramount. I believe that you can go buy a great asset in a great area, but you can mismanage the heck out of it and you'll lose money. Similarly, you can go buy a dodgy house with great property management and probably make money on it. I believe that property management is one of the keys to a successful real estate, investing experience.
I think that goes into the key of any good business, right? It's the people that make the business, right? Yeah. So when a person is the CEO of their real estate investment business, if you will, you have to think like a CEO. There's no CEO out there or board that hires a CFO, a COO, and a CIO because they're willing to take minimum wage. They hire the people that are the best to ensure that business stays afloat and continues to make money regardless of what they got to pay them. So the expense that you have to put out, what I find interesting is some people will think, well, I'm going to go out and find my own properties and I'm going to do my own rehabs and I'm going to do my own management because it's going to save me money. I'm like, that doesn't save you money. You actually get all of those things for free. You get a business or operations divisions for free when you're working with somebody like SBD. And the reason why I say that is because you can drive around the neighborhoods. You can find realtor signs in the yard. And if you find that, you're going to call that realtor that they list that house and you're going to buy that house guaranteed for full market value. And they're going to recommend their brother-in-law who's just started his property management company. And you're going to go through 3 property managers before you find a good one. And you're going to see all the mess that you had to deal with. And as a result of that, you paid full market value. You never really collect the rents you were supposed to. You kind of got screwed around quite a bit. And you ended up where'd you end up with. You're still paying management fees. You're still paying commissions to the realtor. Or you can buy from SBD, who are giving you a market value property. They're going to collect those rents. They're probably going to up your rents by 14%, we just talked about. They've got experience in all of this. You and your team have been doing this for a very, very long time with a lot of houses. And you get all that experience for free because you're paying exactly what you're going to pay the market for screwing it up. So why the hell would you even try and go find somebody in the market to screw this up for you when you can get all of the experience for free?
Dude, I'm blushing. I wasn't looking for a raving advertisement, but I know that you've worked with us for so long now. You know our business intimately, and I appreciate that sentiment because you're right. People can go out there and try and knock it down, do it themselves, but at the end of the day, if you can find a good property management firm that can decrease the 2 biggest killers of cash flow, which are vacancy and maintenance, you're off to a good start.
100%. And that's where I will always, and again, I'm not trying to hump your leg, but I am just trying to let the entire world know what it means to get professionals and be sure that they're ones that people will actually rave about. You can't get me to scream from the rooftops about people who suck. Yeah. Right. Well, I can scream, but I'll tell you that they suck. I don't do that kind of thing for people that are not going to help build my business because I can't put my name next to somebody who sucks at what they do.
Mate, let's step away from the investing world for a minute and talk just in general. Do you feel like we are going to reach some kind of affordability crisis? Do you feel like houses are getting less and less affordable? And how are you seeing that impact your business and the people that are buying homes? Because I know, give the audience a bit of an understanding of your percentage of your business that's investor-based and consumer, just regular homeowners buying their house, and how has that changed over the last 12 months?
Well, I'll just give you a little bit of a quick history. I've been in the industry since 1997. I started off in a broker shop as a telemarketer, and it evolved there. And I discovered the real estate investor in 2003. They're coming into Arizona to buy investment properties from high priced places like California. And then when the crash happened, all that evolved. And I've been focusing on the real estate investor this entire time. My industry has 1.4 million people in it that do the job I do, which is a licensed loan originator or an originator in a bank that doesn't have to carry a license. Of that 1.4 million, just shy of 600,000 of those people closed between 0 and 1 loan per month. Last year, I closed 1,378, and I believe 90+% of them were for real estate investors. Wow. And that's just last year. The year before was 1,300. The year before that was like 900, and you just keep going back. We've got to see where a lot of people make decisions in their business. We get to see where people fail and where they succeed. I would say the one thing that makes us different than anybody else is the fact that when you, as an investor or anybody, faces a decision they've never made a decision about before, a question they've never had to get an answer to before, there's a dang good chance I've seen a lot of people make that decision. I get to see the outcome of their decision, so I can help that person with practical data, not speculation and theory, because there's this old saying, good judgment comes from experience and experience comes from bad judgment. That's a great way to learn on the grade school playground, not a good way to learn the real estate investing. And so it's up to us, myself and yourself, to be sure people have that practical data to make decisions with. Now, how I've seen things evolve, or how I see them evolving right now, is we're short by 5.24 million units in the United States when it comes to housing requirements to just house families. We've had 12 million more households created since 2012. Well, we've only built point some odd million houses to the point now that we're still shy by just over 5.25 million, or just short of 5.25 million. I think that we're going to continue to see the pressure on prices. Sure, it's going to come back a little bit right now because you don't have the enormous amount of people buying for the same property. It's getting down to a little bit of a normal market. They're not sitting on the house for hours. They're sitting on the market for a couple of weeks. This is getting to more of a normal market. Still not normal, still a hot market. So I think we're going to continue to have a negative impact on the market and people's ability to purchase homes. And I think that we're going to still have the real estate investor as probably the premier housing provider for the majority of the markets out there. And one benefit that I have seen lately to all of this is guys like Blackstone stopped buying.
Yeah.
Like 8 different markets.
Yep.
That's a very good thing for us because that's one of the reasons that help push this inventory problem is the big buyers and the hedge funds taking up so much of the available inventory.
Yeah, quite frankly, our investors are thrilled too because we did get we obviously saw this insatiable demand from hedge funds, and Blackstone's obviously the biggest, but there's 20 or 30 of them buying aggressively, and so we created relationships and sold a lot of inventory because they were the bigger idiot, at the end of the day, buying up these assets. But now they've turned off that faucet, and obviously we're re-engaging and reaching out to all of our investors because there is prices have certainly come back down. It's a great time to buy. Let's talk about the criteria. One of the challenges of going through a broker or a mortgage lender is that it can be the argument for not using a mortgage is it can be just time consuming and a lot of bureaucratic red tape, for lack of a better term, a lot of paperwork to get set up. I know that's not an excuse, to not get a loan, but talk to me a little bit when the underwriters and our investors were going through getting underwriting in 2020, there were some crazy mandates coming out during COVID, making sure that people had their businesses still operational. For example, there was a dentist that wanted to get a loan with us, and she had to get a third-party audited financials as part of a Fannie Mae conforming loan process. Has all of that silliness gone away? Are we back to a normalized underwriting procedure?
Oh, yeah. We haven't seen anything like that in a little while. I don't remember when that went away, but we didn't have this whole we still verify a person's employed, right?
Sure.
You still have to go online and take a look if they really truly do have a business that's self-employed. But to the extent that we were going before, a lot of that is tapered back. And to speak to the paperwork, that paperwork's miserable. I tell that people up front, you're getting ready to go through one of the more miserable experiences of life. And that's why we're talking up front, because I don't want you to feel like you're dealing with a miserable person. If you don't like me now, you're definitely not going to like me when I ask for paperwork. So let's just get through that first and build a relationship before you have to go through the suffering that is. And understand, as much suffering as they're going through by putting paperwork into our portal, we got to read that. And that's like 10 times more suffering to have to read the crap that these people have put together in their lives. But it's a partnership that we're willing to do that. So one of the things that we have done to try and alleviate some of the headache associated with that, because you bring up underwriters and they're being really strict and all these other things, underwriters are the ones charged with ensuring that the paperwork and the profile of the individual meets the requirements of those who are putting their money up and lending it out. I mean, their money is on the line here, and it's on the line in a money losing environment. So we can at least be benevolent enough to make sure that the persons they're lending it to can pay it back. Well, a lot of times you're dealing with lenders that say the last week, it's very common for them to call up and say, we got a problem. We got to get this paperwork and solve this issue. We have a really strict underwriter. What I did years ago was, rather than having to battle with whether or not you're going to have a strict underwriter or not, I just hired 3 underwriters to do my pre-quals. And one of them happens to be in it since 1982. She was our regional underwriting manager for 5 years. They're the ones that are going through all the paperwork up front. I have the real estate investors. If you're going to play ball with us, you're going to have to get okay with giving us enough paperwork to get a full underwrite done within 72 hours of starting your application.
Oh, wow.
Because that gives us the ability to issue you a pre-qual letter that's been fully underwritten by people that would typically take 3 weeks for your average lender to give to an underwriter. We do it in 72 hours.
That's fantastic. No, and we continue to hear rave reviews about coming from your service, Security National Mortgage, which, by the way, Aaron, just quick plug, how would people get in touch with you? What's the best way for them to reach out if they're thinking about either coming through us or buying a real estate investment on their own? How can they get in touch with your company?
Best to just go to my website, aaronchapman.com. Security National, I don't own the company. It's a big firm, and they've got a lot of loan originators. You could end up with anybody, right? So it's no different than saying just typing in any person. You'll get basically the same kind of service with anybody else here, except me and my team. We're really, really separate in how we do things. So aaronchapman.com, if that's for some reason to pull up, just Google search Aaron Chapman. There's only one bearded redneck lender out there. The rest of Aaron Chapman's out there. There's a pastor, there's a pro soccer player, and there's an author. And there's me. So you find that guy, you're in the right spot.
If you find that guy, guys, you're going to get treated extremely well. Aaron runs a really tight shop with people that care about getting you through to the end of the transaction and making sure that the hiccups along the way are nullified and any roadblocks are kicked out of the way here pretty quickly. Aaron, I appreciate your time today. It's been enjoyable. I want to just delve into my final couple of questions here. First one is talking about mistakes in real estate. We call this podcast the Mistake-Free Real Estate Podcast, clearly very much tongue-in-cheek. The idea that, hey, I've made all those mistakes in real estate so that others don't have to. I always love hearing stories. If you've got a good one, I'd love to hear it. Can you think of a time when you just absolutely made a blunder, either in real estate investing or in business?
Man, there's a lot of them. It's really it's an attitude thing. Thinking that you're basically unstoppable and bulletproof because you made a few wins. You go in, you start doing irrational things, and trusting that the market is going to go forever.
Yeah,
I did that in 2000, in the early 2000s, and then 2008 happened, and it wasn't just 2008 as a market. I got in a motorcycle accident that put me in a wheelchair and took my memory from me. I rolled in there worth $3 million and 190 pounds, 6'1". I wheeled out at 156 pounds with a negative net worth of 1.5 because everything just got dissipated and obliterated when I came back. And I just made a massive mistake thinking that I could pull off anything, but you don't know what tomorrow's going to bring. So I'm of the mindset for everybody. You got to control what you can control for as long as you can control it. And then when things happen that you're not aware, that you're not ready for, you already have the controls in place.
How quickly did you pivot? And if you had to cut staff to obviously react to, the lack of refis and the lack of business coming your way, or how has that impacted you?
In today's market?
Yeah.
What we actually only cut 3 people from the staff. I had a staff of 32, but then we replaced them. It's kind of interesting.
Wow.
The reason we cut them because what was awesome about the slowdown in business, when we were so just breakneck busy, I had to tolerate people's attitudes and tolerate behaviors because we needed them to fulfill the demand. But when the demand dropped, I could take those people with those behaviors and justify getting rid of them because we didn't need them. I didn't need them to fit the needs or fit the demand that we had. So what we're doing now, rather than cutting staff and taking the route that most people go, I decided to do something different. I hired, you know who Larry Yatch is?
Yes.
I hired Larry and Annie. Larry's a very good friend. I went moose hunting with him in Alaska. Really awesome story. A lot of cool things I've done with Larry. And he and his team are completely going through our entire organization and buttoning everything up. And the philosophy that I have, I don't know if you ever heard of the stream theory delivered by the former CEO of Toyota back in the 70s. He says, look at your business like a stream bed. If you're getting a ton of business and it's overflowing the stream bed, you're losing business, the water overflowing the banks. You will need to dam it up and slow it down enough where you can see where the big rocks are. You pull out the big rocks, you take the dam out, you can get a lot more water in there and never lose any. So my philosophy here is the market is giving me the blessing of slowing that down and damming it up for me so I don't have to. And now I can have Larry and his team come in and say, let's pull all the big rocks out and let's fix everything. So when it comes back and I lift that dam up, we can now do 2 to 3 times more with the same amount of people because we've taken advantage of the situation. So that's what I'm doing with it. I'm not one to hide from it. I'm going to take advantage of what we've been given. It's a gift because if I tried this, let's say, Mark, I did this when it was at the peak and you're trying to close houses every 3 weeks. Then Aaron Chapman decides, hey, Mark, I'm going to slow this down. I'm not going to serve you as good because I'm going to clean up my operation. Well, what happens then? I lose all that business. It goes somewhere else. And then when I pull it all up and say, hey, we're ready to go, market just shifted. right? Market shifted. Now I don't have the flow to justify what I just did. So take advantage of opportunities as they come. And sometimes the greatest things that happen to you are at the time the worst thing that could have happened, but ends up being the best thing that could have happened for your business.
I love that. How much of your team is remote versus in an office building?
Well, I got 32 and only 6 are in an office building. So that, I don't know what the ratio is, but it's quite a bit remote.
So what are you doing to maintain culture and build camaraderie amongst your team members?
Well, it's amazing when you've got the Teams app, for people can chat like that. I have certain people within the team. They're the ones who people go to, and so I had heard somewhere, I can't remember. I think it's Lance Tanaka. If you don't know who Lance Tanaka is, I think he said he was an advisor to CEOs all over the world, Fortune 100 CEOs, and he said that your people like to be touched every 7 days. Says they need to be contacted every single day. I don't have the capability to do that physically. So I took key people that everybody looks to, and I have a chart that every single one of my staff members gets touched by one of them every 7 days. And we go through that, and then I touch them every 7 days. So it's to ensure that people are always talked to, always communicated to. We keep the communication lines open. And then it's, we only have a monthly, Zoom meeting, things like that. But twice a year, we try and get together and have a big gathering with everybody. But the culture comes from the communication and making sure that everybody's checking on each other.
I love that. Last question, mate. I know the question I normally ask is that if, I'm a big golfer and I'm picturing, the last round that you get to play on God's green earth, and you have to pick 3 people that you get to spend the afternoon with, 4 hours walking around a beautiful golf course. I'm picturing Augusta National because hopefully my vision will make it happen one day. But I know you, and I know that you'd probably be more likely seen elsewhere. If you were to sit around a campfire and yuck it up with 3 people, alive or passed on, who would those 3 people be?
It would be a guy by name, well, not a guy by name, but I mean, you've heard of him, Abraham Lincoln. Definitely have to sit down with Lincoln. The guy has, what I identify most with Lincoln is just the fact that he answered a lot of questions with stories. He was just a very, very good storyteller, and probably one of the most, I would say probably the most stubborn people in the world, people I've ever heard of. That guy just stayed at things. So an amazing individual when you read about his history and that kind of thing.
He failed over and over, and it was a classic failure, and then became the greatest successful president ever. Exactly. And there's not a person in the world that hasn't heard of him. The next one, not to just stay with presidents, but who wouldn't want to sit and talk to Washington with what he was up against? And one of the most humble men in the world, when you think about what he did and what he accomplished in his lifetime, and then was able to say, guys, listen, I'm done. I'm serving the country. He's not doing it for own personal reasons. He wasn't doing it to aggrandize George Washington. He was doing it for the sake of the Union and what we were bringing. And then another guy by the name of Porter Rockwell. That was an amazing individual. That guy, you've heard of well, I can't remember. My mind just went blank. But he was a gunfighter back in the day, and a lot of people tried to kill him. He could never be killed. He actually died in his sleep. There was it's amazing why I can't remember. There was another very, very famous gunfighter who was killed in Deadwood, South Dakota. I know the name, but it's freaking just off the top of my head for isn't working. But he was extremely well known for his ability with pistols. And he said, if you ever saw Porter Rockwell walking down the street, coming same direction, he'd cross the street and keep walking. Are these the Wyatt Earp days or way back?
It was the Wyatt Earp days.
Yeah.
Yep. And so it was really an amazing individual. The stories that is told about him, and that I would love to be able to sit down and just chat with him.
Good storytellers. Yeah. I always say that stories control capital. Every time we're pitching an investor on a syndication deal, as an example, you have to tell a story. You have to say, why am I putting capital into this investment? I think stories are an extremely powerful way to control capital.
Well, 100%. And I think that people listen to stories. They identify with stories. Answers to questions leave them with more questions. Well, why is it that the answer, right? But when you give them a story, not only can they see the answer and it makes sense to them, but then they also understand what brings them to that. It's a matter of the cause and understanding the cause more than just the effect. And I think that helping people understand the cause will actually get them to better try and influence the effect.
Aaron, I can't say how much I appreciate you coming on today. A little deep dive on interest rates and where they're going. At the end of the day, you still have to put your money somewhere, right? The one thing we haven't addressed is, people are complaining about a 6% interest rate on an investment property, and yet What else are you gonna? Do you want to just stick your house on your capital under a mattress, or stick it in the stock market? I think being able to leverage and grow is still one of the real estate still stands as a tried and true investment strategy.
Well, let me throw one little quick equation out there to help people wrap their head around that with this percentage thing. Even if you bought a house through SBD and you got no return as far as cash flow on this thing, you just put let's just say $100,000 house, you put $26,000 into it. Your down payment of 20% plus say $6,000 in costs and everything else. That's what left your pocket. But you never made a single dollar in cash flow, but you never put a single dollar back out because of the rents that was able to cover everything else. Just by taking that $80,000 loan, paid off over 30 years by your tenants, of course, you're going to find that they're going to pay off an average of $2,666.67 per year. Go ahead and do the math. And then you go and hit your divide button and type in the $26,000 that you invested. You'll find that your $26,000 grew by 10.25% of the original $26,000 every year for that 30 years. If that's all you made, you still won. You still beat most everything else out there. You still have tax benefits. You still have appreciation. And eventually, even if you weren't making any money at that point, rent raise is going to make you some cash flow. So there's so many different ways you're making money on this that if you're so worried about where that interest rate and everything sits, look at all the different angles that real estate benefits you. There's nothing else you're going to find that's going to do anything better.
Completely agree, dude. Principal pay down and appreciation, balance sheet items, really. And that's why they don't show up on a P&L. And everyone's so stuck on their P&L, they lose sight of the grand picture, which is really, you're not really investing for the immediate cash flow. I think those investors that come in and hope that $100 a month will change their life are not the investors for us. We're looking for the ones that are going to buy and hold quality assets long term that will change their family tree through the methods that you just talked about. A tenant or resident paying off the mortgage for you, the asset doubling value every 20 years, and the ability to leverage and scale the operation.
Exactly. And as they pay it down significantly, go and do a cash out, pull that money back out and see what you can do with that.
Yep.
Then you can see how things compound. And then you start seeing this cash on cash return is incalculable. So I get excited about it. I nerd out on it. I get jumping up and down. I'm spitting into the phone. I'm talking to people about these numbers. I appreciate you giving me the forum and the platform to talk to people about it, because this is what I love. And it's amazing how I can love this kind of crap, because this has not been my background if you look back at my history, but it's amazing. It's awesome things to see happen.
If you guys are looking for a way to get into real estate through leverage and through mortgage, as we teach here at SBD Housing, cannot speak more highly about Aaron Chapman. Reach out to him, aaronchapman.com. As you heard, 98% of all of his deal flow is with investors, and he did 1,378 deals last year. This guy's a pro, and he's a friend, and I appreciate you coming on the show today, buddy. Thank you so much.
Thanks, brother. I'm looking forward to doing it again.
Let's do it. Thanks, man.
You're listening to Mistake-Free Real Estate Radio, the authority in passive real estate investing. No late-night calls, no clogged drains, no tenant nightmares. Take the passive investor's approach to real estate investing and trust a turnkey professional. Learn more at mistakefreerealestate.com. Until next time, remember, you don't get rich from what you earn, you get rich from what you own.